us to another transition into a fireside chat that is next. Uh, this one will explore the intricacies of the journey of building and preserving scale wealth in an economy that offers opportunities, that also goes through multiple cycles, and therefore how to see that. We have with us somebody who has sort of seen this economy open up in the early 90s and reach where we are today. So I would like to welcome upon stage Shri Gaurav Dalmia, Chairman of Dalmia Group Holdings, a visionary leader who has whose work spans across investment, wealth creation, and has a profound knowledge of the markets in India. Joining him in conversation is Alok Mittal, co-founder and executive chairman, Indifi Technologies, and President TIE Delhi-NCR. Over to Alok.
Thank you, Pasna, and welcome, Gaurav. You've been in this investment space for a long time. Just for people in the audience, Gaurav was a board member at my first company, Jobs Ahead. And I may fall into calling him Bhaiya during the course of the conversation because that is what I've called him always. So, you've been in the investment business for a long, long time, and specifically even the startup investment business. You were, of course, a general partner at one of the earliest funds, Infinity. You continue to be a partner now in True North. How have you seen the evolution of the startup investing space over the last 25 years?
Well, so if you go back into the late 90s, that's when the startup scene really started picking up. And there's enough evidence that you need a bubble to create a new industry. So the tech bubble of 2000, which culminated in 2000, was a big source of startups coming, venture capital coming. And had that bubble not happened, the startup scene in India would have been delayed. Okay. And this is true for the automotive boom, by the way, in the early 1900s. That also was fueled by a bubble. And railroads were fueled by a bubble. So there's nothing wrong with it. Mm-hmm. Now, in the 90s, late 90s, early 2000s, when the startup scene in India was emerging, there were no rules of the game. There were no formulas. Everyone was discovering what was going on. It was a small industry. It was a nascent industry. But great companies got funded at that time. So if you look back today and look back at Bharti Telecom, had Warburg Pincus not been around, Bharti Telecom may or may not have been the company it is today, because it was in a capital-intensive business. It was an underdog. Remember, all its competitors at that time were conglomerates. These guys were a startup. Take another example, InfoEdge, which was a competitor of Jobs Ahead. Right. InfoEdge was created because it raised venture capital from ICICI Venture. Jobs Ahead raised venture capital from Chris Capital. And we were head-to-head. And today, InfoEdge is a couple of $1 billion market cap company. So there's enough evidence from that time that 15 years from then, if you saw, right, Bharti Telecom was a great company, InfoEdge was a great company, and there'll be several from that era. Today, of course, the industry has matured. So a VC knows what he is doing. So he will say, I do early stage, I do Series A, Series B, I do angel, I do late stage. Or somebody will say, I do private equity, I do pre-IPO, which is later stage. Right? So the segments are now clearer. These segments were not that clear then. The service providers are exceptionally good now. So if you go to a CA, your CA, and saying, I'm trying to raise private equity or venture capital, he'll give you a template. If you went to your lawyer, he'll give you a template. All this didn't exist. This has evolved in the last 20 years. New sectors have evolved. For example, venture debt is a phenomenon of the last 10 years, really, or maybe even less. Okay. The secondaries business, again, last 5-10 years, it's picked up. Right. So a lot of subsectors to private equity and venture capital have come up, and we will mimic what's happened in the West. We'll mimic what's happened in the rest of Asia. I just want to give you one number. 28% of VC activity volumes in Asia Pacific are today in India. So that's the stage that we have reached we've matured to.
You talked a little bit about this role of bull runs in creating markets. And, I think in the venture space, we tend to see one of these years every 4 or 5 years, right? So one bull year every 4 or 5 years. Last one was obviously 2021. These spikes still seem to, catch us off guard. And what I mean by that is, a lot of new investors enter the market when this happens. They are perhaps doing it for the first time because they're suddenly seeing, valuations climb up. And then they tend to kind of leave the market a bit hurt. They have exhausted their capacity to invest in the market. India still remains a country of very new GPs, right? So most of the GPs operating the market are first-time GPs, even today, in spite of the maturity. What are the lessons for them in venture capital that you would like to share? How to approach the market? How's money made in this market?
So let me give you one statistic, or rather anecdote, about general partners that I've seen as an investor. We tend not to invest in funds. Mm-hmm. We tend to be a direct investor. But in certain things that we don't do ourselves, we are a fund investor, such as tech, we don't do ourselves so much because it's way too specialized and we always want someone else to blame. So a GP is a good idea. So the funds that we have at least monitored and some that we've invested in, a first fund typically for a new GP is easy to raise because typically they raise their first fund on the back of their track record elsewhere. Where say I was working at such and such firm, I'm leaving. It's typically done in a bull market. So the hurdles are pretty low. And you raise your first fund, small fund, right? Friends and family, people who work with you, you raise the first fund. It's relatively easy. 2-3 years later, now you want to raise your second fund. And to me, that's relatively easy as well because you show mark-to-market returns, okay, of your first fund. So they may not be liquidated returns, but they are marked to market. So based on that number, you can possibly raise a second fund. The real test comes in your third fund, because by the time a third fund is up and about, which is let's say 6 years down, people say, this mark to market is fine. What's the actual money that you made in the last 6 years in your first fund? At least show me that. That is where many VCs stumble. So I think the real test of a VC is if you can raise your third fund, right, you're on a good wicket. If you're not able to raise, if you're on your first or second fund, it's not clear that you're on a good wicket yet.
But let me push that a little bit on what it means for a VC, a general partner who's operating a fund. Let me kind of draw an analogy to this. In a public market scenario, you have some mental models on, let's say, how do you pace your investments in the market? How do you rebalance your portfolio? So if you follow that, in a bull market, you'll end up taking money out. In a bear market, hopefully, if you have the courage, you'll end up putting money in. What are the similar mental models that one can deploy when looking at venture? Because it's obviously not a liquid investment. It's not getting mark to market every day in real sense. How should a GP think about pacing themselves in a venture market?
You see, a good VC is like a good entrepreneur. There's really no difference. If you're a good entrepreneur trying to do a fintech company, a VC would ask you, what's your niche? Why are you doing this? How will you do this? As an LP, I will ask exactly the same questions in a slightly different way to this entrepreneur who's trying to be a venture capitalist. So you've got to define your segment clearly, that I will do early stage, mid stage, I will do these 3 industries. And increasingly, it's becoming a function of specialization. You will specialize in an industry because that's how you develop judgment. In the end, you're not paid for analysis. In the end, you're paid for judgment. And a judgment develops when you do some things repeatedly and well. Okay. So that's the first thing, you have to develop judgment. Second thing is you have to think like an owner, that you own a business. You have to stop thinking like a broker, I'm using the word loosely, that you're managing somebody else's money, abhi bull run chal raha hai, kar lo. If it was your father's money, is that the way you would put it to work? If yes, please put the fund money to work. If no, if in doubt, my view is don't do it. So that's the second thing. Don't get carried away by a bull run, which destroys many fund performances. Third thing is have a team. Okay? Just like you would go to a company and say, show me your ESOP pool, how deep is it? Right? If it's not reasonably deep, you will argue that it should be deeper. I would say the same thing for a VC. How deep is your carry pool, the equivalent of your ESOP pool? Okay? This is a booming industry. There's going to be a lot of churn. The only way to retain the best talent is to have a reasonably deep carry pool. Right? So do that. Even if it means less economics for you, you have to be long-term greedy. It doesn't matter what you do in your first or second fund. Fourth, many people tend to underestimate what it takes to build a business. The real action starts after you invest. Right? Before you invest, you're analyzing, you're rejecting, you're negotiating. To me, that's 20% of the action. 80% of the action is after you've invested. And if you don't have the capacity to struggle with a company who's building, and every build out of a business is somewhat of a struggle, right? You will not be a good VC. Today, the world is where entrepreneurs choose their VCs in many ways. So you've got to be a VC that entrepreneurs want to work with, even though you may not be the highest or the most valuable, most expensive term sheet. So you've got to be long-term greedy, you've got to have your head on your shoulders, and be a good partner.
Let me get on the other side of the table, right? You mentioned the specialization that is coming into the GP world, right? By sector, stage. A lot of domestic capital has come into the ecosystem over the last 5-6 years, right? This is represented by LPs, which might be family offices, HNIs, and at some level, with the desire to do both fund investments as well as direct investments. Now, this is a very complex kind of investment landscape to navigate for an LP team, right? Just what is kind of your, call it a roadmap, a blueprint to say how should LPs be navigating this? And in the context where a lot of these family offices, at least in context of what we have seen globally, seem to be subscale, right? They're running a 300 crore pool, they're running a 200 crore pool, but they're trying to make decisions which is, hey, which sector, technology, non-technology, which stage, right? Timing of the investment. How should LPs be viewing this market?
So I would recommend everybody read a book by a man called Nicholas Taleb. It's called Fooled by Randomness. And he talks about cycles, or you can apply that learning into cycles, so he talks a little bit about cycles. And he talks about random events and how we tend to get carried away by random events, thinking there's a signal there when there is none. It's noise. So one of the rules I would suggest investors should have is don't go by what the newspaper is telling you today, because that's a snapshot. Look at the full movie. The full movie may be the market was, I'm taking a stock market example because that's easier. The market was at XP. This sector was at YP. It's moved from Y to 1.3Y P, and earnings are lagging consensus or earnings are beating consensus, or whatever the story is. So understand the full movie. Don't get fooled by randomness, which is what if you take a snapshot of today, you might do. So that's the first thing. Secondly, do understand that when you're investing in a venture situation, you're investing for 10 years. If you don't have the capacity to invest for 10 years, don't do it. You may get a flip in between in 3 years, but don't go and bug your investment manager after 4 years. Oh, what do you have to show for all the 4 years of work that you've done? Because he may have nothing to show in the first 4 years except pieces of paper. Third thing is, please do a top-down analysis of how much risk you want to take. So if you have $100 of surplus income, surplus capital, which you want to invest as a family office, right? How much should go into fixed income? How much should go into private equity? How much should go into public markets, etc. And then allocate money. Just don't do opportunistic stuff because it will not have the conviction. If your opportunities don't work out, you will try and get in and out early, and venture capital and private equity is not something where you can get in and out early. In public markets, you can correct your mistakes still. Here, you can't really correct your mistakes. Fourthly, my view is, unless you're a certain size, okay, and the rule I would propose, and this rule can be corrected by people depending on the circumstance, if you're not investing $100 million, okay, I'm taking $100 million as a round figure, right, in direct deals, don't even try. The rule of thumb in a VC firm is you need a partner for every $100 million.
I think that's the US rule. In
US
India,
rule.
yeah.
India, it may be $70 million. Yeah. Right? So for a family office, why should that rule be that much different? If a VC has a partner for a $50 million, $70 million pool, and you have a $30 million pool, that means you can't afford a partner. Yeah. And if you can't afford a partner, I'm using the word partner loosely, that kind of skill, you will not do the best deals. And therefore, I'm better off giving the money to another VC who has the skill, right? And the difference, by the way, between gross and net returns that you should be aware of and not be shocked by later is about 7%. So if a VC comes and tells you, I make 30%, right? He actually delivers you a return of 23%. And the leakage is, he raises $100, he never invests $100. He invests, let's say, 80 out of that $100. So on 80, he's making a large return, right? But you want your return on 100. Then the return he makes, he takes a profit share. So approximately you should take away 7% between gross and net. I would argue even after that, you are better off giving money to a VC if you are subscale or a private equity firm if you are subscale rather than trying to do it yourselves. Most of my friends who've tried to do direct deals, and they're smart businessmen otherwise, most of them are unhappy with their performance. Direct portfolio.
And tell me on the counter side, as I mentioned, a lot of GPs in India are still first time, second time GPs, right? They're not proven GPs by any stretch of imagination. So if you are an LP sitting on the other side of the table, what are you looking for in these GPs? Because it's too early to assess performance. Even the VCs who've been around for a while have literally gone from a $100 million fund to a $500 million fund over 3 fund cycles. So what is it that one should be looking for?
Well, I would look at basic things. What's the skin in the game for the management team, for the sponsors, for the partners in the GP? What sectors are they focusing on? Have they had major style drift? Because many people are just opportunistic. They'll start with idea A, 4 years later they'll do Y, something B, and there's got to be a very good reason. There's no difficulty in moving from A to B, except unless there's a good reason, then you're wondering here, is this guy just floating around rather than doing something seriously? Fourth, look at the interim performance of the underlying portfolio. There'll be some interim performance. The interim performance may not be of valuation yet, but you can say, look, when you made this investment, right, since then, these 4 companies in your portfolio have grown well. So you made the right choice, you know. So you'll have to measure on a qualitative and interim basis, just like you would do for your own business. Suppose you started your own business, some new business, new capex, new plant in a new location, and it's 4 years old or 2 years old. How would you judge it? Not on the P&L of that plant. If you did management accounting, you wouldn't do P&L of that plant because it can't have P&L. It's not reached full capacity utilization necessarily. So same way.
Again, many of the LPs that are coming are family offices. You know, the promoters there have actually built successful businesses, right? And there's always that lens of saying, you know, we know there is experience in there. The new economy behaves very differently. The entrepreneurs behave very differently, and they have become successful in very different ways. What is it that in this kind of partitioned world, as I'm projecting it, the old economy founders can learn from the new economy entrepreneurs?
See, I think there's plenty that old economy entrepreneurs can learn from the new economy. And also, I think vice versa. There's a lot that old economy can teach the new economy. So for example, if you're a family office, old economy type, and you have a portfolio of businesses that you've seen, whether you've invested in it or not, there's plenty to learn. For example, the energy levels that are there in a young startup, I'd kill for it to get that energy level in a big company. I would do anything it takes to somehow mimic that. Secondly, there's internal trust in a startup. The number of mistakes a startup makes and recovers from, people don't get fired. In a large company, you make a similar mistake and you will wonder whether your career is at risk. In a startup, it's iterative. So you've got to have an iterative approach as you're growing fast. Third, there's a man, I think his name is Peter Singer or something, and he wrote a book called The Fifth Discipline. And the point he makes in that book is you've got to have confidence and humility at the same time. If you can mix these two, you will achieve anything. And startups typically have a lot of optimism. You can argue they have misplaced optimism. Yet they have the humility to evolve and pivot and saying, this is not working, I'll do that. Right? We, in the old economy, sometimes get too sticky with an idea. Ye idea tha, why change? So you've got to be able to have confidence and humility. So Jeff Bezos is famous for saying, you must have day one thinking. Because if you go over the day one thinking, and let's call it day two thinking, okay, it'll be status, and that status will eventually lead to irrelevance. So you should always be hungry and think like an entrepreneur. Now, think of what you could teach a startup. So there's been study of German middle market companies, which are family businesses. And they found that these businesses, and today Germany may not be the best example in the world economy because it's suffering, but if you again take a 10, 20-year view, German middle market companies have been global. The studies show that they have longer term thinking. Their reinvestment of profits into growing the business is far more as compared to other companies which are publicly listed, they'll give out more dividends. Okay. There's a shared sense of destiny. If we are in this together for 20 years, we'll be in this together for another 20 years. So there's a lot of that kind of stuff, long-term thinking, shared sense of destiny, reinvesting, etc. And, Peter Kaufman is a guy who's written a book called, I don't know what the book is called, but it's on Charlie Munger, who used to be vice chairman of Berkshire Hathaway, who passed away a couple of years ago. So he says, what does he look for in a businessman or a marketing manager or whatever? And he's a billionaire. This guy is a billionaire himself, big Berkshire shareholder. And he says the lowest level is what you call smart. From that, you get to intelligent. Then you get to brilliant, then you get to genius. He says there's something above that. It's called simple. He says simple beats smart any day. And I think businesses that have evolved, right, understand this better than businesses that are young. So I think that's one more thing an established business can teach a young company.
Interesting. If there are any questions in the audience, please do raise your hand. I can talk to Gaurav all day long, but we'd like to just, have an opportunity to take any questions that the audience might have. Please. Yeah.
Hi, Gaurav. Rohit here. Thanks. Nice hearing Taleb and Munger in a forum like this.
Can you speak up a little bit? Can't hear you.
Sorry, there was feedback there. So, quick question for you. In your journey of building businesses and investing in businesses, who are your heroes that you look up to?
I have two heroes, and they contradict each other so many times that I'm very confused. Okay. So one hero, a bigger hero, I would say, is Warren Buffett. And he's a deep value investor. And the lesson from him is, in the short term, the world is a voting machine, or investments is a voting machine. In the long term, it's a weighing machine, right? So valuation of a company can get hyped up because it's a voting machine. 20 years later or 5 years later, the hype blows up because the earnings never kept pace. That's a simple example of that, but you can apply this everywhere. On the other side, there is a man called George Soros. Okay. Forget his political affiliations and his political comments, but his returns are one of the best in the world over long periods of time. So Warren Buffett's returns are about 21% over 40 years. Soros's was about 28% over 30 years. But they were levered returns, so they're not really comparable. Soros's returns were levered. Buffett's were mostly unlevered. And Soros has a theory which he calls the theory of reflexivity. And he says you should know how to ride momentum, and that's how Soros has made money. He doesn't care about deep value. He doesn't care about all that. In here, boss, bubble chal raha hai, looto. And he's done that successfully. He knows when to short, when to be long, and so on. So I think as mental models, you should be able to apply both. I would say, I would like to be 80% Warren Buffett and 20% George Soros. Okay? But you've got to be able to see what your own temperament is and invest.
Are you able to get to 20% Soros?
Well, there are a lot of temptations to be 70% Soros, but yeah, I think we contain ourselves at 20% Soros. But by the way, Soros deals with a lot more volatility than Buffett deals with. Yeah. So it takes a different amount of nerve to play like Soros does.
No, the reason I asked that is because I've never really seen you talk like
Soros.
what Soros would imply, right?
Yeah.
Yeah.
We are mostly Buffett, yeah.
And yeah, please.
Given where the Indian ecosystem stands right now, what would you think would be a reasonable return to expect from venture capital as an asset class? Obviously, given all the differences in the liquidity in the private market versus the public market and so on.
Can I answer this in two questions, in two different answers? Okay. Let me step away from today and say what kind of return should you expect from venture capital in general, and then we can look at timing, what happens starting today. So if you knew nothing else, you know what India's nominal GDP growth is. Actually, the government measures nominal GDP growth, subtracts inflation, and reports the real GDP growth number, 6% or whatever. They don't measure that. They actually measure nominal GDP growth. So let's assume nominal GDP growth is 11%, out of which they subtract 5% inflation and report a 6% GDP growth number. If nominal GDP growth is 11%, revenue growth of companies on average should be 11%, right? If revenue growth of companies on average is 15%, you throw in some operating leverage, profit growth should be about 13%, right? So long term, your market index should give you about 13, 14%. And so if you see the empirical evidence, you've got 14% over 30 years. Okay. Now let me ask you a trick question and I'll come back to the answer. If you invested $1, 1 rupee in 1986, what would it be worth today in the index? Any guesses? I'll simplify it for you. What? Please go ahead.
64, 70 times in rupee terms is a lot less than dollar terms.
770 times. The Sensex was 100 in 1986 when it started. It's 77,000 today. Okay. So 14% is this magic. This is that magic. Okay. So you don't have to beat it. You don't have to struggle to beat it. Okay. That's lesson number one. Lesson number two, we don't follow the Nifty or the Sensex because it's a representative sample of India. And I don't want to invest in a representative sample of India. I want to cherry pick where I think I can make more money. So for example, in the index, there are some commodity companies or this or that. Nifty has another index called the Nifty Quality Index, which takes away the high capital intensive businesses and keeps only the high return on capital employed type business. It will remove Coal India, it will remove some of the commodity companies. So we actually monitor ourselves vis-a-vis the Nifty Quality Index, not against the Nifty. The Nifty Quality Index, as it is, delivers about 250 basis points more than the Nifty. So if you think India will grow at 11% or 12%, right? Nifty corporate earnings will grow at 14%, Nifty will grow at 14%, Nifty Quality Index will grow at 16.5%. Then we come to the mid-cap index that may grow at 18%, small cap 20%, private equity 23, 24%, venture capital 27%. You can almost create a table which is reasonably scientific, and over long periods of time, that kind of table should hold. Okay. Now we come to the second question. What would you start expecting from today, given where we are? Let's assume we are in a bubble. I believe we are in a bubble. Okay. If that is correct, and if you were to invest in Infosys in 2000, you would be underwater for 10 years with nothing to show for it. In the meantime, this Infosys from 2000 to 2010, I don't know what their revenue growth or profit growth was, but it was huge. Maybe profits grew 4 times in that 10-year period, okay, or more. So Infosys, the company, had a different life. Infosys, the stock, had a completely different life. If you were sitting now in 2003 or 4, and the stock is 50% down or 30% down or whatever it was, and you forgot to read the P&L, and you only read the stock price, and you say, Babu, bhago isme se. To marne ka kaam hai. But if you saw the P&L, you say, company is doing great. So I would say, if we are in a bubble today, which I believe we are, you may have periods, 2 years, 3 years, 4 years, with 0 returns, okay, or negative returns in certain stocks. However, if you take a long-term view, a 10-year view, okay, I would say on average, you will come back to that Nifty kind of return, on average. But not everybody can have a 10-year view from today. They may have a 2-year, 3-year view, which in my case, if I had to bet, would be very, very conservative.
Great. We are out of time. This has been a fascinating conversation. Thanks so much for taking the time out. Yeah. Thank you.
Thank you.
Thank you so much, Gaurav. Thank you, Alok. I think that was a masterclass in investment. It was far too short. We could have been with it for a couple more hours and learned so much more, especially the uninitiated like me. I don't know about everybody else, but I think it was equally gratifying for everybody. Thank you so much once again. Thank you.